Hello and welcome once again to the 365 Retirement Podcast with the team at Rubino Liang Wealth Partners. Each week we sit down with either Ryan or John or Sam and sit down and talk through some of the issues that you might be thinking about and wondering about when it comes to retirement. Today, Ryan Marston is with us. Ryan, how are you doing today?
I'm great, Randy. It's always a pleasure to be here in studio with you.
Well, one of the things that I try to do is each of you has kind of your own little specialty. You know, Sam talks a lot about protection and income, and John talks a lot about markets. But you, my friend, are my tax guy. So we're going to talk a little bit about taxes. So I thought I would bring this. Yeah, absolutely. In the fourth quarter of the year, this is the time of year when there's probably a window of opportunity for some people on December 31st, getting some things done before the end of the year, isn't there?
Yeah, you certainly don't want to wait till December 31st, but this is the time of year that you want to be taking a look at everything and seeing, if you can prove your situation from just like a tax standpoint and taking advantage of the current tax year.
Well, one of the things we always talk about is, financial planning, retirement planning. It's not just this coming April 15th. It's all the April 15th to come. So that's kind of what we're going to talk about today. And it is interesting. I saw a study that said, why are people coming to see their financial advisors this year? And the number one reason this year, 2024, that people are coming to see their financial advisors is to talk to them about converting money from their 401k over to a Roth, doing those conversions. And we talk about that regularly. This is a good tax move for you. So does that kind of hold true with you guys? Is that some of the things that people are coming to you about? And why would they be coming to you? Who makes them a good candidate for this?
So the candidacy, a lot of people are certainly, I think, more aware of Roth conversions. I don't know if there's more of a presence in terms of like the media and what they're seeing online, TV, whatever it might be. But everyone should be considering it, right? And then whether or not you follow through with it is a whole other thing. You want to see where you stand from a tax standpoint on the current year, trying to be as accurate as possible. And, a lot of sometimes it might not make sense. You might be in an unfavorable tax bracket, or there might be other ramifications to whether it's Social Security, Medicare premiums via IRMA. You don't want to cross certain thresholds, but, I'd say more often than not, you want to fill the bracket you're in. A lot of people are in favorable brackets, and if you can convert tax-deferred assets to tax-free assets moving forward, pay some tax, obviously, at that point of conversion, but now be in a favorable or have a favorable bucket of assets or money moving forward, it could make a big difference in a lot of people's retirement strategies.
So I always remember my father-in-law, who was in his mid-70s, and he was writing checks to the government for $30,000, $40,000 a year, and he couldn't believe it. What's the problem here? He had a big pension, he had Social Security, and he had saved a bunch of money in a 401k. So he was in a really good shape for retirement, but he was not in a really good shape for taxes. And so just explain to us the reason that somebody would do this.
Yeah, absolutely. It's like, to put it simply in, where I start most conversations is if you have $1 million in a, tax-deferred 401k, traditional or rollover IRA, well, that $1 million isn't necessarily all yours, right? As we know, I know Uncle Sam and the tax money has got a piece of that as you make distributions. Well, if you have the same $1 million in a Roth IRA or, even Roth 401k, a tax-free vehicle, well, that is your money. That is your, when you make withdrawals, you don't have to worry about the tax considerations or consequences of that withdrawal. So that, that's a big difference. When just starting the conversation there is that is all your money versus some is going out the door to taxes, whether it's federal and state or just federal moving forward. So that's like the start of the conversation. But from there it would progress to everyone's individual situation, and if it actually makes sense. You don't want to put yourself in an unfavorable bracket all of a sudden just to make Roth conversions when you might be in a more favorable bracket moving forward.
So the idea here is that when you get to that point where the government says to you, you have to start taking this money, which is called an RMD, a required minimum distribution, and that age right now is 73, but it is soon moving up to 75. So when the government says to you, they put you on kind of a schedule, don't they? They say you have to take this much out and you got to pay this much taxes, and you don't really have a choice, do you?
No, you don't. And so, part of the conversation when we sit down with our prospects or clients and take a look at things, and, we can project out what your RMDs are going to be at age 73 or 75 if you're born after a certain year. But we can project out what your RMD is going to be. And if sometimes, or, maybe half the time, that RMD is actually more than what they need to cover expenses. So, you're forced to take out more money than you need. It gets coupled on top of maybe pensions, Social Security, other forms of income you have coming in. And, now 73 on, you're forced to take out that lump sum, and it could knock you into an unfavorable tax bracket. It could trigger IRMA, premium, Medicare Part B and D, surcharges. So, when we're looking at things like that, we take a look at the short term, what does it do there? But more importantly, does it improve your long-term situation? That is like the number one goal, is looking at the long-term situation and improving everything from not just, again, not an investment strategy. This is just a tax standpoint, more tax efficiency in your retirement accounts or retirement plan moving forward.
So this also becomes important when it comes to legacy, too, because if you were to give your kids a 401k, they would have to pay the taxes on that money. But if you were to give them a Roth, those taxes have already been paid. So it's a nicer gift when you're giving it to them tax-free, isn't it?
It is. And I have some clients that we're not making Roth conversions for them to put them in a better situation. We're making Roth conversions for their estate and what they're going to be leaving to their kids. Now, when they leave those assets to their heirs, as a non-spouse heir, they still have to, whether it's an inherited IRA, inherited Roth IRA, the kids still have to dispose of it under the current laws or rules over a 10-year period. But when they're making withdrawals from an inherited Roth IRA, it doesn't affect them on a tax standpoint. It doesn't, get lumps on top of whatever their earned income is at that point in time versus a traditional inherited IRA. Now that would get lumped on top of whatever that heir's income taxes are, earned income is. And they might be in a, if the kids are in their 50s or, when they're inheriting their assets, they're probably in their biggest earnings years. And now they're forced to take out an inherited IRA over a 10-year period, which could be pretty unfavorable from a tax standpoint. So, the Roth IRA not only can improve our clients' situations, but, beyond that, if they're in a great situation, it improves their estate plan, their net worth, assets, and what they can leave as an inheritance to their kids.
So let's talk about the schedule of how you do this and how much, because we always encourage people to come in, a couple of years before you retire. So if like 65 is your date, your age, come in at 62, maybe you start these things early. How do you figure out that math to figure out how much they should convert systematically until they get all of it out of the tax wash? Yeah.
So there's a couple ways to look at it, right? So if we have someone coming in a couple years ahead of retirement and work with us, we take a look at what their earned income is. We projected for the year 2024. We look at their brackets, where they stand right now. We work with their accountant, and from there, they may have a little bit of a wiggle room in their brackets to start the Roth conversion process. But more often than not, with retirement on the horizon, the biggest years of Roth conversions are probably going to be at retirement when their income levels drop. But it allows us to start the process or set up the plan to initiate. So if they're retiring at 65, we can make some pretty favorable Roth conversions, maybe 65 to all the way to 72 ahead of that RMD age, and really start to project out. And then over that period of time, we soften the blow as opposed to making some big ones over a short period of time. We can soften the tax blow by expanding it over a little bit longer period of a time and do it gradually and get the money into the Roth IRA, start earning tax-free, and have no, tax repercussions moving forward on any withdrawals.
Well, when we talk about doing the math on your retirement, this is certainly a big part of that. And from the sounds of it, it's like while you're working, maybe you convert a little bit. As you retire, you convert a little bit more with a goal to get all of it out of the 401k or some of it, half of it. What's the goal here?
It depends. It depends what we're looking at. It depends what the client's needs are. If we can get if they have a significant amount in pre-tax assets, tax-deferred assets like a 401k or IRA, 403b, not always can we get everything out, but can we get your RMD to a manageable number at age 73 where it's what you're going to be needing anyways, right? So if we can reduce it as much as possible to get that RMD lower, but do it over a period of time, that's ideal. If we can get everything out, without biting off too big of a tax bullet, and move it into the Roth areas, then that's great. Then you don't have to worry about your RMDs or taxation in the future, because the RMD or any withdrawals from tax-deferred assets can have other ramifications beyond just true taxes on earned income, right? It can affect what your Social Security gets taxed at, because your Social Security gets taxed at your highest marginal rate, so that's the highest bracket you're in. So there's other effects that we want to make sure we consider, and certainly moving forward for the long-term range, 73 beyond. Like if again, Social Security, hopefully you have a nice, healthy, long retirement. If we can have a less of an impact from taxation on Social Security, well, that's great. That's more net earned income just from Social Security we can get you to cover expenses. So it has other effects like that as well.
Well, it's exciting to look at a big balance in a 401k, but you also have to know it's not all yours. And when you get into retirement, when you start accessing that money, it's like paying to get like going through a toll booth to get your own money. You have to pay the taxes first, then you get your money. And you can put together a strategy with Ryan and the team at Rubino and Liang Wealth Partners to slowly but surely move that out of the taxes and the tax wash, as I call it, and get it over to a place where it's all yours. You've paid the taxes on it, and when you access it, it's all yours. This is a conversation you can sit down and have with the team. Give us a call. What we do is a 15-minute introductory call. And this, if somebody's got a huge balance in their 401k, Ryan, this might be the topic of your conversation when you talk about this.
Absolutely. That 15-minute introductory call is a chance to ask any questions on your end, in our end, and maybe explore just initial opportunities. See if it's a fit to work together. And then from there, if there's something I think we or us or the team can help that prospect with, we'll express it on that call. And if there's a fit on the prospect's end, we'll from there, what we'll do is progress to the next steps and take a little bit more in depth of a look. But that 15-minute call is a great chance to ask any questions that you may have, any concerns or worries you may have, and see if we can, if we're the right fit to kind of progress forward.
Well, there's two ways to find out about that. You can go to our website, which is 365retirement.com. There's a button up at the top that says Talk to an Advisor, or you can give us a call as well, and we'll have that number for you here in just a second. But in any event, if you are going into retirement with a big 401k, this is a discussion you're going to want to have. The tax discussion many times is very much glossed over, but there's so much to know, and Ryan's the guy to help you out. Give us a look on our website once again, 365retirement.com, and we hope you join us again next time here on the 365 Retirement Podcast.